Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Thomas DiFazio. Thomas is a director on the investment strategy and technical research team. Thomas, how are you doing today?
I'm great, Ross. Thanks for having me here today. How are you?
I'm doing really well. Good to talk to you. You are kind of instrumental in the firm's sector and asset allocation efforts, and we often talk about that. And we got you at a perfect time because there were a lot of changes to your all's most recent sector allocation that I want to work through. Let's start with upgrading energy and materials, two kind of commodity-linked cyclical sectors. What prompted that move, and how do you think about those going forward?
Absolutely. We upgraded energy and materials both from neutral weights to overweights in our recommended sector allocation. Starting with materials, at its baseline, we believe that there is a big trend change underway within the industrial metal space. A lot of those industrial metals are breaking out, and if you look a little bit more specifically, copper and gold, the trends are higher. That being said, you can expect a little bit of a consolidation here. It's not crazy when you see such impressive moves moving out of big bases, but ultimately we think the bias for these metals are higher. And when you also consider from a fundamental perspective, these improving commodity prices are good for overall sector free cash flow, and we think that could prove an important tailwind for the materials sector. Similarly with energy, we're seeing crude on an upward trajectory toward 90, albeit with some volatility. And with higher crude prices, that comes with higher free cash flow estimates as well as higher sector profits. As well, from a market perspective, the other important consideration here is that the trade is not crowded. If you look at energy sector ETF flows on a rolling one-year basis, they're responding from historically depressed levels, but there's ample room for them to move higher here before the trade gets crowded, and that helped to provide a pretty attractive entry point here for energy.
Yeah, I think that makes a lot of sense. But looking at the other upgrade you all made, and I'm wondering if you could kind of square this circle. Upgrade to utilities, traditionally defensive sector, high yielder at a time when rates are moving higher. What prompted that? And I'd note it's only upgraded to neutral, so you're not making a pound the table call here. But what sparked the interest there?
Certainly. With utilities, we're trying to appreciate the nuanced improvement that's going on under the hood. Now, if you look at the equal weight construction of the overall utility sector, you are going to see that there is some early signs of relative leadership coming about. Now, it's hardly full-throated. There's work to be done here. But the other important development that's been going on as relative performance has improved with rates going in either direction is that the percent of stocks in an uptrend has also been moving higher. So when you put it all together, you're seeing an improvement internally as well as at the surface level for the utility space. And this is right now with higher rates. And we think that's a change of tone that should just be recognized. We're not ready to go all out on embracing the utility sector, but we want to respect the message that the market's telling us here.
Yeah, and I think it's interesting. It kind of, in my mind, pairs with some of your all's work on how high quality stocks have been outperforming. There's just this a little bit of skepticism about the bull market rally or the economic backdrop that's leading people to still allocate to higher quality shares, to defensive shares, and not totally just embrace the cyclicality of the market. So good to know. Let's end on a downer here and look at the downgrades. So consumer discretionary and healthcare. Could you just give a little bit on each one and why you thought to downgrade them?
Yeah, we'd be happy to. Regarding discretionary, part of our thinking here is that when we downgraded discretionary, it's hard to see consumer discretionary and energy work together consistently historically. That is a factor in our mindset there. But when you think about from a fundamental perspective, an important consideration is our in-house Strategas Common Man CPI measure. When you compare that with the headline CPI as well as consumer wages, the Strategas Common Man CPI is treading higher than both, which would insinuate that there's a little bit of a pinch going on in the consumers that we don't know is being respected or appreciated right now in the marketplace. From a market perspective, the other consideration that we're watching is the equal weight discretionary versus equal weight staples measure. Now, this has been a very important cyclical barometer for us, and that ratio is currently oversold. What's going to be important going forward is how it rallies from those oversold conditions. If consumer discretionary responds very strongly here and you see a broad rally, then that would be an encouraging sign that cyclicality still permeates the marketplace, and that would be a tailwind. If we don't see that type of rally, then we may need to start to ask a couple more serious questions about where we should be allocated cyclically and what that means for the defensive shares within the overall market. Last but not least, we did downgrade healthcare from overweight to underweight. And really, the main thought process here is that it is such a high opportunity cost right now to hold healthcare in the overweight position. Healthcare right now has been sitting from a relative performance perspective in the bottom decile historically. Now, that has been a condition that tends to encourage a spark of relative leadership just because of the statistical nature of that condition. But we have yet to see it, and we have grown impatient and don't believe that the sector deserves this type of loyalty when there are other places to put money to work in the market, especially when you consider that we're in an election year and neither candidate is particularly good for the healthcare sector. And that's what led us to our downgrade in that part of our recommendations.
Absolutely. Well, Thomas, this has been really insightful. I would note to anyone watching that you can find a fuller report on this on bairdwealth.com. So check that out. But Thomas, again, thank you so much for the time, and we'll talk again soon.
It's my pleasure, Ross. Thanks for having me.